Implementing effective position sizing in Forex trading. Introduction. Position sizing is a critical aspect of Forex trading that determines the amount of capital allocated to each trade. Effective position sizing is essential for managing risk, optimizing potential returns, and preserving trading capital. For Forex traders, mastering position sizing techniques is crucial to achieve consistent profitability and long-term success. In this text, we will explore the importance of effective position sizing, various position sizing methods, and best practices for implementing position sizing in Forex trading. Importance of effective position sizing. Effective position sizing is vital for the following reasons. Risk management. Proper position sizing helps control the amount of risk per trade, ensuring that losses are limited and do not deplete the trading account excessively. Account preservation. By controlling risk, traders protect their trading capital and avoid the risk of ruin, allowing them to continue trading in the long run. Capital optimization. Allocating an appropriate portion of capital to each trade optimizes potential returns and minimizes the impact of losing trades on overall account performance. Common position sizing methods. Fixed percentage risk. Traders risk a fixed percentage of their trading capital on each trade, such as 1% or 2%. This method adjusts position size based on account size and risk tolerance. Fixed dollar amount. Traders risk a fixed dollar amount per trade regardless of the size of their trading capital. This approach allows for consistency in risk management. Volatility-based position sizing. Position size is determined by the volatility of the currency pair being traded. More volatile pairs receive smaller position sizes to account for larger potential price swings. Kelly criterion. This formula considers the probability of success and the reward-to-risk ratio to determine the optimal position size that maximizes long-term returns. Calculating position size. Position size can be calculated using various methods based on the chosen position sizing approach. For fixed percentage risk, the formula is as follows. Position size equals multiplication of account size and risk percentage divided by multiplication of stop-loss distance in pips and pip value. Setting stop-loss levels. Effective position sizing relies on setting appropriate stop-loss levels to control risk. Stop-loss orders should be placed strategically based on technical analysis, support and resistance levels, and market conditions. Pyramiding and scaling out. Pyramiding involves adding to a winning position as the trade moves in the trader's favor. Scaling out involves taking partial profits at predefined levels. Both techniques can influence position sizing and risk management. Adjusting position size for correlated trades. Traders should consider the correlation between currency pairs in their portfolio. If multiple trades are correlated, reducing position sizes can help avoid overexposure to a particular currency or event. Monitoring account performance. Regularly assess account performance and adjust position sizing if the account size increases or decreases. This ensures that risk remains consistent with the chosen position sizing method. Emphasize discipline and patience. Maintain discipline in adhering to the chosen position sizing method and avoid making impulsive changes based on emotional reactions to recent trades. Conclusion. Implementing effective position sizing in Forex trading is a fundamental aspect of risk management and trading success. By using various position sizing methods, traders can tailor their risk exposure to their risk tolerance and trading goals. Calculating position size based on the chosen method, setting appropriate stop-loss levels, and considering correlations between trades are essential for controlling risk and optimizing returns. As with any trading strategy, discipline, patience, and continuous monitoring of account performance are vital for maintaining effective position sizing throughout the dynamic and ever-changing Forex market. With a well-defined position sizing strategy, intermediate Forex traders can build a solid foundation for achieving consistent profitability and long-term success in their trading journey.